In a recent video, I went through the tax brackets that we're all going to be subject to in 2026. But boy, judging from the comment section, there seems to be a lot of confusion about how to actually apply those brackets to our income. And especially anytime there is some ordinary income mixed in with some capital gains. So I want to go through some actual examples today in this video where you can actually see this working and how this is applied on your tax return. I want to go through quickly the 2025 standard deductions, individual income brackets, capital gains tax brackets, and then I want to take a look at how these two types of incomes come together on your tax return. That would be ordinary income and your capital gains. And then I want to talk about gold and silver just a little bit because there's some things here that you also really need to be aware of if you invest in any of those. Now, we're looking at the 2025 because these are the brackets that you'll be using next spring when you do your tax return. Okay, so now the standard deduction in 2025 for a single filer, $15,750, married filing jointly, double that, and head of household, $23,625. If somebody is 65 or older, they get an additional $2,000 if they're single and $3,200 if they're married. And then over and above even all of that, okay, the big bill that was just passed in July gives them an additional $6,000 if they're single and $12,000 if they're married. Okay, so that begins to phase out for higher incomes. That would be $75,000 for a single person and $150,000 for a married couple. This starts in 2025 and runs through 2028, just the $6,000 additional bonus. Okay, now the federal tax rates and brackets. Okay, this is for ordinary income like your salary and what we call short-term capital gains, which is any investment that you made that you did not hold for a full year. That gets taxed just the same as your salary. Now, you can see here the 10% bracket for a single person goes up to $11,925, double that for married, and then we have had a household at $17,000. Okay, we can see the different brackets here. It goes all the way up to 37%. And you can pause this if you'd like and kind of look at these brackets. Now, this is for, again, ordinary income and short-term capital gains. I do want to mention something about gold and silver here. The IRS defines that as a collectible, so it's taxed the same as like art or jewelry, the profits. And unfortunately, it does not get the more favorable long-term capital gains brackets applied to it. It gets these brackets applied, except it's capped at 28%. Okay, so something to be aware of there. And by the way, that applies to whether you own bullion, coins, or even an ETF backed by the metals. Okay, now long-term capital gains rates. You're in the 0% bracket for a single person all the way up to $48,350. Married filing jointly, $96,700, and head of household, $64,750. The 15% tax bracket, it actually goes up to pretty large amounts here. You can see $533,400 for a single person, $600,050 for a married couple. Okay, if we get over those amounts, then it jumps to 20%. Now, I do want to mention that it's possible if you are higher income, you get hit with an additional 3.8% tax here. Okay, for a single person, the threshold is $200,000 for your modified adjusted gross income, or $250,000 for a married couple. If you're over those thresholds, you get hit with a 3.8% tax on the amount that you're over those thresholds, or it's applied to your net investment income, whichever those two is the lesser. So a little complicated, but just be aware this was put into effect in 2013 to help provide some benefits to the ACA plan. Now, let me take a quick moment before we get to the examples. I'd sure appreciate if you hit the like button. Leave me some comments below about what you think of the video, or maybe just what you think about in taxes in general. So, okay, let's get to the examples. Now, first example, a single filer making $80,000. You get to subtract off the standard deduction. Now, we're going to keep this simple. We're only going to look at the salary and standard deduction. No other deductions, no tax deferred retirement contributions, no other income. So we get to subtract off their standard deduction for a single person, which leaves $64,250 of taxable income. Now, that's represented here by the red arrow. Notice it does get into the 22% tax bracket. That does not mean that all of that is taxed at 22%. Okay, so the 10% tax bracket for a single person went up to $11,925. That portion gets taxed at 10%. $36,550 falls in this range. That gets taxed at 12%. And only $15,775 spills into the 22% tax bracket. That gets taxed at 22%. We add up these three figures, and we have $9,049 of federal tax. Does not include any state income tax if you have that. Or, of course, it doesn't include Social Security and Medicare tax, which, of course, is taken out of your check also. Now, notice that we did get into the 22% bracket. So that is called our marginal tax rate. That's basically the taxes on the last dollar you earned. Then we have what's called the effective tax. That's where you take the tax that is due divided by your total taxable income. Our effective tax is 14%. Our marginal tax rate is 22%. Okay? All right, now let's take a look at a married couple filing jointly, earning $100,000. They get to subtract off their standard deduction. Okay, we're going to take a married couple under the age of 65, so they're not getting any of those additional bonuses. Their standard deduction is $31,500, leaving $68,500 in total taxable income at this point. Now, notice their income then on their tax bracket doesn't even get to the 22% bracket. $23,850 is taxed at 10%. Okay? And then only $44,650 that spills into the 12% bracket, and that would be $5,500 or $358. We add up those two, and their total federal tax on the $100,000 of gross salary is $7,743. Okay. Now, their marginal rate then was 12%. Their effective tax rate was 11.3. Now, let's take a look at how ordinary income and capital gains work together. Okay, remember we just looked at a married couple with $100,000 of salary, and they paid $7,743 in federal tax. Now we're going to take a married couple earning the same $100,000 worth of salary, and we're going to add in an additional $40,000 of capital gains. What you want to remember here is capital gains, regardless of how much somebody might have, doesn't affect how your salary or your ordinary income will be taxed. So on that $100,000, you still have the exact same $7,743 of tax. Think of capital gains too. $40,000, that's just the profit. So let's say they own stock that had doubled in value. They might have sold $80,000 worth of stock, and only $40,000 of that is profit. That would be your long-term capital gains. Now, in this case, the capital gains does not affect ordinary income, but ordinary income certainly does affect how your capital gains will be taxed. You have to take your $40,000 of capital gains and stack it on top of the $68,500 of your taxable income that came from your salary. So now your total taxable income is $108,500. Remember, for a married couple under the long-term capital gains bracket, the 0% bracket went all the way up to $96,700. So only $11,800 of this $108,500 spills over that. That is the amount that then ends up in the 15% bracket. So that gets taxed at 15%. So we have an additional $1,770 of additional tax. We add that to the tax from their salary, and the total tax due is $9,513. So I hope this has been helpful of, especially this example of how ordinary income and capital gains mix together. Please hit the like button. Let me know your comments below, and thank you for watching.